Hey, Steve Saretsky here, as always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value and entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. A little bit of housekeeping news here. We're going to start ramping up some of the content on this channel. Obviously, we're growing pretty well here. We've ramped up the content production, 30 some odd thousand views on the last week's video. So what we're planning to do is basically once a month, we're going to do a long form interview segment. Again, I think I mentioned to you guys, our next interview guest will be Jeff Booth. So we'll kind of talk a lot about Bitcoin and the money printing, et cetera, et cetera. But I'm also going to do for sort of the long-time listeners, when they originally came to this channel, was all about Vancouver real estate. So we're going to do like once a month, we're going to do like the deep dive video that solely focuses on what's exactly happening in the Vancouver housing market. So that'll be in addition to these weekly videos that we're doing here now. But without further ado, these weekly videos will continue to focus on the larger macro picture in the Canadian economic housing landscape. So I think let's get into this week's video. And I think to frame up this week's video, let's have no other person I can think of but CIBC's chief economist, Benjamin Tao, with his recent comments right here.
If rates go up tomorrow by 200 basis points, that will lead to a significant softening in the market. It's not going to happen. So the question is how sustainable this trend is. And I think it's sustainable. Clearly, we are in a double-dip recession now. The economy is shrinking. You will see the housing market slowing along the line of what we're seeing in the economy as a whole. But you don't see speculation in the system. You don't see 2016, 2017 type situation. It's really a more balanced market. The softness that we are seeing in the rental market is a very healthy softness. The adjustment we are seeing in the condo space in big cities is something that we expected, and it's healthy. And what you see in the low-rise segment of the market makes absolute sense given the desire to live in bigger places. However, I suggest that after this softness, we will stabilize. I don't see a collapse in the housing market. Prices are high, and unfortunately, they will remain high even after COVID. That's the reality of the situation in the Canadian housing market until we fix the supply issue that is really impacting valuations in big cities.
So Benny keeps talking about supply of housing. Ben, I think we've got that figured out, buddy. I think if you look at the number of units under construction in Canada, far beyond anything that we've ever seen. In Vancouver anyways, you've got record completions, and yet prices continue to push higher. So Benjamin, what are we missing here? He unfortunately doesn't focus, and for obvious reasons, because he works at the bank and nobody really wants to talk about this stuff, is he's not talking about the supply of credit. It is the supply of credit is what drives house valuations. Think about it this way. Let's kind of break this down. You have a levered asset, basically, because especially in Vancouver and Toronto where valuations are sky high, most people need a mortgage. If you don't get a mortgage, you can't support those valuations. So you need to continue to extend credit and ever more credit in order to support the valuations which the banks hold on their balance sheets. So all you have to do is watch the banks, because the banks basically, if the banks are lending money, housing market will be doing well. If the banks start tightening up credit, the housing market doesn't do well. So, all you have to do is follow residential mortgage credit growth. Residential mortgage credit growth, as of November, which is our last data point, and courtesy of my friend Ben Rabideau of North Cove Advisors, is you have residential mortgage credit growth in Canada growing at 7.5% on a year-over-year basis. That's the fastest pace of growth in residential mortgage credit growth since 2011. So you've got a 10-year high of this credit growth that's basically pumping up the housing market. And so again, think about it. If banks tighten credit, housing market goes down. Banks loosen credit, housing market goes up. It's very, very simple. It's a function of liquidity. So you can almost forget the underlying fundamentals, because the banks are basically in control of the asset class. So I'm going to help you unpack this a little bit further so you can kind of understand what is going on. So we have to look at this because normally what happens in downturns is banks will start to tighten credit. And as the banks start to tighten, so normally what happens is you're going to raise interest rates. The banks start tightening, reining in credit. And it kind of is a self-fulfilling prophecy. As you raise interest rates and tighten credit, the asset prices start to come off. That pulls the froth out of the market. Then you restart the next cycle. In this example that we're in today, is policymakers saw what was happening. So you couldn't just put your hands up in the air and say, okay, we're going to shut down the global economy and not do anything and just see what happens. Because you would have asset prices would collapse, you would have already massive unemployment get even worse, and you would have Great Depression 2.0. So policymakers basically said, okay, here's what we're going to do. We are going to shut the economy down, essentially, but we are going to continue to pump money into the financial system. So we're going to try to keep asset prices levitated. If you can support asset valuations, the hope is that you can then create basically a wealth effect off that. So for example, what we saw here in Canada was you said they had OSFI, the banking regulator, come in and lower banks' capital reserve requirements. So they lowered those. They did all these mortgage deferrals, and that was obviously they were aided in the ability to do that by having the Bank of Canada step in and basically, provide basically quantitative easing, which is money printing, purchasing of assets to lower interest rates to basically be the buyer of last resort to sort of calm the market down. And then basically behind closed doors, you had regulators basically tap the banks on the shoulder and said, listen, you guys, we're going to basically, the Bank of Canada is going to support you through QE. We're going to lower your capital reserve requirements. You guys are going to pump money out the door. You're going to just issue new loans. You're going to pump the housing market. And we're going to support the economy by having a strong housing market. That's in essence what happened. And so if you're wondering why residential mortgage credit growth is growing at the pace that it is in this environment, and you're wondering why national home prices are at record highs, up 13% on the year, this is why. And so you can sit here and disagree and argue with it and say, I don't believe in that philosophy. That's not the right thing to do. Policymakers shouldn't do that. That's beside the point. The point is this is the mechanism that they've chosen to use. So if you own asset prices, if you own assets such as real estate, stocks, you've done tremendously well during this pandemic. If you haven't, you've fallen further and further behind. But again, this is going to continue because this is the recovery plan that they have chosen. They have chosen to support asset prices. They've chosen to support financial assets in the hopes that it will create a wealth effect from those assets. But I think it's important now to understand the mechanism behind it because you have residential credit growth. So let's understand credit, for example. Money is credit. So when credit is issued, when credit is created, new money is created. So think of credit and money as the same thing. So when I tell you banks created new credit, they created new money. Banks can do this at the click of a button. They can issue new credit or new money at the click of a keyboard. The only thing that stops them is capital reserve requirements. Now remember, OSFI already lowered the capital reserve requirements. They said, you go create new money. You have the free reign to do that. And you have our support. Us, the Bank of Canada, the Trudeau government. Go create the money. So this is the mechanism. So now, so they've created that money. Because you have to remember, when people start paying down debts, which they're doing, households are repairing their balance sheet, so they're going and paying off their visas, they're going and paying off other loans that they have because everybody's scared. They're building up their savings, they're paying down their debts. When you pay down debts, you destroy money out of the system. So think about it this way. New loan means new money into the system. So when you create a loan like a residential mortgage, you inject money into the system. When you pay down that mortgage or when you pay off your visa, you're basically deleting money out of the financial system. However, the economic model and the economic system, the financial system that we have created depends on new credit growth. So in order to spur credit growth, you need to spur spending, and spending is created by people borrowing money and spending that. And that basically allows the system to go through. So you're in a credit-based monetary system. That's what it is. I didn't create the system. Do I think it's great? No. Do I think that there's probably better ways to do it? Probably. But this is the system. So you have to continue to get ever more credit, which is basically debt. So the debt burdens must continue to grow and grow and grow. And so this is the mechanism that why banks did that. They said, okay, well, the easiest way to pump money into the system is to basically just issue a whole bunch of new residential mortgages. That way we can keep the system going, and we can keep the system basically lubricated. We can support the housing market, and that will hopefully encourage people to go out and buy new furniture. House values go up. Now you can go buy a new car. And so that's the mechanism that they've chosen to basically bail out the economy. It's let's support it through new loans in the residential mortgage, in the residential space, and such that you have new prices or higher prices. So I hope that makes sense, because I get this question a lot. People just really not understanding the financial system. I'm trying to basically dumb it down so you can understand, because so many people are like, well, this doesn't really seem right. How can they do that? How can we just kind of create money? How come the housing market's going up right now? This is why, because you have a credit-based system that relies on new credit entering the system. The easiest and most secure way to create that credit is to have it secured against an asset like real estate. It's much more safe in a bank's eyes than lending it out to some entrepreneur who has a 50% success rate of his business failing or succeeding. So for the bank, you're basically issuing a loan against a piece of land. So that's kind of my thoughts this week. Clearly, as we can see, what's happening in the housing market, it is all by design. You have, nobody will in the media will talk about it. Benjamin Talent, CIBC is not going to talk about it. But what you have right now is you have rampant credit growth that's concentrated in the residential mortgage space. So you have higher real estate prices right now, despite the underlying fundamentals that continue to deteriorate. The lockdowns continue to go on, and without the pumping of the credit system, you would be likely in a Great Depression 2.0. So you can argue that they don't really have much of a choice. You can argue, again, that there's no such thing as a free lunch, and the repercussions of such are going to be higher asset prices, which creates further lack of affordability and choke on that millennials. So that's what we have here today. So as always, hope this video helped. Hope it brought you some value, entertainment. Hit the thumbs up button, subscribe. We'll see you next week.